Hello, everybody. Welcome to the Altamir half-year results presentation for the results 2021. I'm pleased to introduce you Maurice Chéniaud, President of Altamir, and Eric Sabia, CFO of Altamir.
Thank you, Claire. Good morning or good afternoon or good evening, everyone. We will skip the presentation of Altamir that you know quite well by now, and we'll go directly to the European private equity market. And as you can see on slide 11, the market for buyout investment in the first half was very strong, with 207 billion euro invested compared to 181 billion for the full year 2020. And in terms of divestment, it's slightly less significant. However, 101 million compared to 43 million for the first half 2020. Moving to the highlights of Altamir for the first half, our NAV grew by 8.9% in the first half compared to 1.6% in 2020, including the dividend, driven by a 15.4% average EBITDA growth compared to 1.9% a year ago. We achieved 328 million of divestment compared to 25 million in H1 2020, and we made 10 new investments versus 3 for 195 million compared to 28 million a year ago, and we ended June with a 91 million statutory net cash position compared to 42 million a year ago. Moving to page 14, you have a presentation of 10 years of our divestment activity, and you can see with 328 million of divestment for the first half only, we are all close to the 378 million of 2019 for the full year, which was our record year. Out of these 328 million of divestment, 246 million were comprised of free full divestment, 104 million for Tom Group, where we made only 1.4 times our cost, 96.8 million free one-time cost for PIP, where we invested in 2018, and 45 million for Sandaya, 2.1 time cost for an investment of 2016. There were 82 million of partial exit, the most significant one being Expereo at 63 million. This is a partial sale since we reinvested roughly 30% in the deal, and that deal generated almost 2.5 times cost in less than 3 years. And the other partial exits were mostly IPOs or shares sold on the stock market. In terms of our investment, we made 195 million of new investment, including follow-on of 34 million, 116 million of new investment in 10 new investments. And on page 17, you have a breakdown of those investments. 5 investments in tech and telco, Infogame is a Silicon Valley digital transformation software service company. Ercevec is a Canadian cybersecurity company. Lutech is an Italian IT services and solution provider. Cybergrants is a leading provider of SaaS solutions for corporate social responsibility. And finally, EPC, which was done alongside the Apex Mid-Market 10, is a leading independent pan-European CRM software provider, Belgium-based. In the healthcare sector, we invested in Rodenstock, a German manufacturer of premium ophthalmic lenses. And moving to the next page, we made 3 investments in the consumer area, i.e. Nulo, which is a fast-growing pet food brand, Idealista, a leading online real estate platform in Spain, Italy, and Portugal, You may recall that this was an investment in Apax 9 LP. We reinvested alongside EQT when they acquired both the Spanish business and Italian leader. Tom Group is a leading pan-European jewelry chain, which we are one of the leading investors. And finally, in the services business, we invested in a UK-based leading independent specialist insurance intermediary. On page 19, you have the NAV growth per share since 2012, and you can see that we ended to 2021 with 32 euro plus 56 per share, including the 1.09 euro per share. This translated in 8.9% NAV growth in the first half of 2021. I will transfer the floor to Eric, who will give you the NAV creation in the first half.
Thank you, Maurice. Hello. So I'm going to begin on page 20 with the NAV bridge. The main item on this slide are the value creation on the left of the slide, 141 million of value creation over the period, which could be split into 19 million of unrealized gain and 22 million of realized. Those 2 million are, of course, linked to the exit Maurice mentioned just before. Moving on to the next item, we have 90 million of costs, all of direct and indirect costs, 26 million euro of carried interest provision, which of course impacts negatively the value creation over the period, and the dividend we paid in May this year, almost 40 million euro, gives us the final item, the final NAV at the end of June, 1,189 million euros. Moving on to slide 21, we have the value creation breakdown. We have broken down the value creation by sector, and you can see that 68% of the value creation is coming from the TMT sector, 19% from the healthcare sector, 30% from the service sector. The three negative progression over the period being Marlink, Alain Foulou, and Antoria will be commented by Maurice later on. Moving on to page 22, we have on the left the breakdown of the unrealized gain by key drivers. And we can see that the main item is the EBITDA growth. Over the period, it has created a value of 206 million euro, impacted negatively mainly by the change in net debt, as we have added debt on the portfolio to make bolt-on acquisition on the portfolio. On the right, you can see the portfolio bridge at fair market value between December 2020 and June 2021. And we can see that even if we have exited many companies on the portfolio, the new investments we have made added to the unrealized gain we have created over the period brings us to have still an increase of 90 million in the portfolio value at the end of June. On page 23, you can see the portfolio at cost and its evolution between December 2020 and June 2021. And we can see that even with, once again, with the mini exit we have done, we still have a very good level of investment, and we are almost at the statutory net worth as this one, which we have added on the slide on the top right, is 786 million euros. And this portfolio is still well spread over the four sectors in which we invest. Moving on to page 24, we can see the portfolio valuation and the different metrics we use to value our portfolio. The main changes between end of December last year are the progression of the portfolio held at cost, 15% by now. This is linked to the many investments we have made over the period, and the progression of the listed valuation used is mainly linked to the IPO that happened during the period, and the progression of the company already evaluated using the listed price between December and June, of course. On page 25, we present you the uplift, and we can see that the uplift over the period is 14%. This number reflects the progression of the exit price compared to the last valuation at which we had the company in our book prior to the sale, and 14% is a good level, and it's in line with basically with the previous year. it might go down by the end of this year as we have some exits, mainly Marlink, which will be commented by Maurice later on, which could impact this figure by year-end. Moving on to page 26, on the commitment side, we have two buckets, one which is linked to the 2016 vintage and the other, for which we almost have no more commitment to pay. The more active ones are the 2019 vintage, for which we have Apax Mid-Market and the Apax Mid-Market and the Apax 10 LLP fund. It's worth mentioning that we have increased our commitments both on the Apax 10 LP and the Apax Mid-Market 10 funds over the period, 20 million for the Apax 10 LP fund and 76 million euros for the Apax Mid-Market 10 funds. We have also committed 15 million to the Apax Digital 2 fund, and we have also committed 10 million in a co-investment in Destiny. Out of those 650 million euro, 130 million have already been invested by the underlying funds, but not called yet. Those funds are using credit line at their level, and they will call the money over the next 12 months. Moving on to page 27, the cash situation. We have, at the end of June, an adequate level of cash. Our statutory cash position is 91 million euro, and our IFRS cash position is minus 15 euro. And it's worth mentioning that this amount does not include the final proceeds we should receive from the exit of BIP, which should be received by the end of September. This cash could be split almost 50-50 between our net cash we currently have on the balance sheet and our short-term investment in the IVO fund for 49 million euros. On top of this cash, we have 100 of credit facility available to date, which are not drawn at all at the end of June. I now hand over to Maurice for the strategy.
Okay. The other main information in the first half of 2021 was a new step in our diversification strategy. You may recall that when we did the IPO, the takeover bid on Altamir by Amboise, I indicated to the market that we will continue our existing strategy to invest primarily with the Apax funds, both Apax LLP and Apax Mid-Market. However, I indicated to the market that we would take advantage of our evergreen position by making investments which have a time horizon longer than private equity funds horizons, and also to increase our exposure to North America and Asia. As in implementation of that strategy, we took a first step early this year by investing 100 million in Tom Group, and we took a second step by allocating 90 million over the next 3 years, 30 million per year, in funds at PCI, named Altamir Global with a vintage year, launched by Amboise Partners. The benefits for Altamir for using that strategy is that we will be able to access top-tier funds which require high minimum investment amounts, as well as significant follow-on investment capabilities, and we expect to be able to build a long-term relationship with the managers selected in those funds. As a first step of this strategy, we are in the process of launching the Altamir Global 2021 vintage with a 110 million target size. That fund will be subscribed with 30 million by Altamir, and 80 million will be offered to retail investors. The Altamir Global 2021 vintage will be invested as follows: 50 million in Apax Mid-Market 10 and Apax 10 LP, 40 million euro, i.e. $50 million, managed by General Atlantic and Insight Partners, two US-based managers with a global investment strategy in buyout and growth companies in the same sectors as Apax, particularly tech and telco and healthcare, and 20 million in co-investment, out of which 10 million have already been committed to Destiny. The commitment to these funds made by by Altamir have been made by Altamir on behalf of Altamir Global 2021, and they are temporarily carried on its balance sheet. When the closing of this fund, which is expected to take place at the end of December, will happen, Altamir will transfer all these investments which are on its balance sheet to Altamir Global 2021, and will obviously maintain a 30 million investments. Moving to page 30, unfortunately, we have to announce you that we had an unexpected event in our governance. It is with deep and profound sorrow that we learned of the passing away of Jean-Hugues Loyer during the month of August. Jean-Hugues had been a member of our supervisory board since 2006, and was chairman of the board from 2015 to 2020. We are very grateful to him for all that he has accomplished, and we present our most sincere condolences to his family. The board will meet on September 8th to launch the selection procedure for a new member. Moving to the events post-June 2021, the summer has been very busy. First of all, the Apax Mid-Market 10 Fund has held its final closing at 1.6 billion, well above its initial target of 1.2 billion, and we have committed to it 426 million, as indicated before. 3 companies have gone public, Multi-Classified Group and Pecor, and Thoughtworks is just in the process of going public this week. In August, Apax Partners SAS entered into a put agreement with Providence Equity for the partial sale of Marlink, and that investment is expected to close in the first quarter of 2022. Apax LLP has signed the acquisition of 2 transforming acquisitions for Cybergrants, and to create a major company in the social good ecosystem. And Apax 10 LLP has signed 2 new investments, Saber Tree, which is a leading professional tree and shrub and lawn care provider, and alongside the strategy of fruit management, which Apax 10 is very specialized in, and an agreement to acquire T-Mobile Netherlands alongside with Warburg Pincus, again building on the experience of Apax LLP, who has done numerous transactions in this field, the latest one being Orange in Switzerland. Lastly, Apax Digital and Apax Development have announced new investment and divestments. As you know, moving to our portfolio, as you know, the value of our company is the value of its portfolio. On page 33, you see that roughly we have 62 companies in our portfolio for 1.3 billion, 58 million of investments. 22% of that are direct investments. 47% are investment alongside Apax Mid-Market France, and 30% are investment alongside Apax LLP. If you move to page 34, you see that our portfolio is well diversified by sector, with 58% in tech and telco, 14% in services, 20% in consumer, and 8% in healthcare by fair market value. In terms of vintage, it's also well diversified by vintage and by geography, even though here the companies are listed on the basis of their headquarters, but a lot of companies are international in scope and cover several continents. Moving to page 35, we look at the EBITDA growth of our portfolio, and over the past 10 years, we have always overachieved compared to the 35 companies of the CAC 40. However, in H1 21, for the first time, due to the sharp drop in 2020, the CAC 40 companies have overperformed our portfolio company, but we expect that to be a short-term performance. I will skip page 36 and 37. We provide you a breakdown of sales growth and EBITDA growth of our portfolio. You can spend the time to look at them. And move to page 38, and you see that the average EBITDA of the 37 companies in our portfolio out of the 62, which are valued on the basis of EBITDA, the EBITDA has slightly increased, not significantly, and the debt multiple is roughly stable at 4.9 times EBITDA. The 20 largest investments represent 78% of the portfolio at fair market value. That is due to the fact that 15%, as Eric mentioned, of our portfolio companies are valued at cost, and when they will be revalued at the end of December, obviously we expect that it will take a lower number of companies to represent 80% of our portfolio valuation. Moving to snapshots on our portfolio of the 20 companies which represent 78%, I will be brief. Marlink, strong performance, partial exit expected in Q1 2022, and a reinvestment, significant reinvestment of the Apex fund. And for Vista, a major transforming acquisition which reinforced the global networks business, which prior to this acquisition represented 90% of the business, and the divestiture of a global enterprise division. So therefore, the business is now completely focused on global networks. VIP, as we said, exit at 3.1 times cost. Thoughtworks is in the process of going public at a very high valuation and tremendous performance, as you can see. Greatech, which was a 2019 investment, has rebounded strongly, and as you can see, 50% EBITDA growth, major acquisition, strengthening of the management team. Similar situation with Destiny, which made two transforming acquisitions, which were financed both by debt and additional equity investment, including a co-investment of 10 million alongside the Fund 10. Odigo, again, company valued at cost, and tremendous transformation going on. Experio, again, divestiture and reinvestment, and the business continued to perform well. Experio is valued at cost of a new reinvestment. Paycor, U.S. company which went public, and the IPO was priced at 23 euros per share and is now trading above that price. Vocalcom, which is the oldest investment alongside Apex 8 mid-market fund, is performing well, and the transformation from licensed business to a SaaS cloud model is now almost completely achieved, with 70% of cloud sales, or 70% of sales being represented by cloud sales. AEB in the services business, significant acquisition in France, which is a major wine country, and a strong performance in the first half. Antoria is a problem situation. The management team has been completely revamped, and a major transformation plan, restructuring plan is going on, which we expect will bring back the company, which is presently valued slightly below cost, to better movement. Crystal, it's a 2021 investment valued at cost, and since our investment, 7 transforming acquisitions have taken place. A pipeline of additional build-up is being finalized, and finally, the management team has been strengthened with a new CFO, head of business development, and many manager. Tom, which is the leading jewelry retailer in Europe in the consumer field, continues to perform strongly despite the closure of the stores due to the COVID, and is showing 12% EBITDA growth in the first half of in H1 2021, which and the business continues to perform strongly. Snack development is showed despite the robust activity in France, that was offset by lower sales in the UK and Spain. And while major EBITDA improvement initiatives have been taking place, unfortunately they were offset by increasing cost of raw materials, but we expect this to be a short-term aspect. In consumer, Alain Flelou, which is a leading European franchisor for optical and hearing aid products, the company is performing very strongly. However, as you have seen in our valuation, we have significantly increased the discount at which we are valuing this company due to the fact that we have a liquidity issue with the majority shareholder. In the healthcare sector, Mental Better is a new investment valued at cost. Again, significant progress during the first half of our tenure with reinforcement of the management team, an significant acquisition being closed, and a digital transformation in progress. Unilabs, which is a European leader in diagnostic services, very strong results driven by the COVID, and so we expect significant upside. And finally, in the healthcare sector, Candela and Innovage, two US companies, one in the sector of selling aesthetic device to professionals, has recovered strongly from the COVID, and Innovage, which is a market leader in managing the care of high-cost dual-eligible senior in the United States, is also working very well. So that is the story behind our portfolio. Moving on page 53 regarding our total return NAV performance over 10, 5, 3, and 1 year. As you can see, we are overperforming our benchmark LPX Europe NAV by significant amounts over the 4 periods. And in terms of our dividend policy, taking into account the discount at which our share price is trading, we deliver a 4.1% yield by paying a 3% NAV dividend, NAV dividend. And in terms of our total shareholder return, again, compared to the LPX Europe index and the CAC Mid Small index, we are overperforming those two indexes, again, by significant amounts. In conclusion, our objectives, we had presented to you in March our 5-year objectives, where we expected to invest roughly 170 million per year on average. In H1 2021, we have already achieved the full year results with 195 million. In terms of divestment, a similar story. We expected to divest 230 million on average, and we have divested 328 million in the first half, and we were shooting for a 7% average EBITDA growth on an organic basis, and we have achieved in the first half 15.4% EBITDA growth, including M&A growth. This concludes our presentation of the first half 2021 results. We are at your disposal if you have any questions. Don't hesitate to call either Claire, our investor relations, Eric, our CFO, or myself, and we are at your disposal. Thank you for listening and participating, and have a nice evening.